AltX has lifted the interest rate for investors in its Class A of the AltX Credit Fund. Nick Raphaely from AltX joins me now to discuss why. Hi, Nick.
Hi,
Thanks
Nadine.
for joining
How are you?
us. Yeah, good, thank you.
Good.
Why
good to
in
be
this
back on the show.
environment? What gives you that confidence?
So I think we're trying to respond to what investors are looking for. Maybe perhaps I'll wind it back just to give a bit of context to who AltX is and what we do. So we call ourselves an integrated alternative asset manager focused on real estate credit. So when I say integrated, in simple terms, we both find the investments. So we've got borrowers, brokers, and originators who bring us mortgage-backed deals. Think about them as loans secured against property on the one side. And on the other side, we bring the investors. So we integrate the investor piece with the product piece and we put it together, and that is the AltX model. So we have a range of products that give investors access to deals backed by first mortgages on property in Australia. Our flagship product is the AltX Credit Fund, and that has a number of share classes. And Class A is the share class in which we've recently raised our interest rate or raised the rates payable to investors, which bucks the trend. You know, we recently had a rate cut. The whole rate bracket moved down. So if you had money on deposit at a bank, a term deposit, or money at call, whatever the case may be, you'd now be earning less than you would have been earning, 4 or 5 weeks ago. We saw investors responding to this, investors looking for something which can actually lift it for them and give them a high yield, not a lower yield. So it was really in response to what we were seeing in the market and what investors were looking to us saying, what can we do to make the product more compelling in this environment? And if I can take it one step further, I think the trend is likely to be further rate reductions, if the forecasters are to be believed over the coming months towards the end of the year. And so having a product which has a higher rate, not a lower rate of interest, is very attractive for people who are seeking a yield investment.
Yeah, I get it, but that's not free money. It has to come from somewhere. I mean, you can't keep lifting your interest rates, presumably, every time interest rates are cut.
Absolutely, and we need to do a lot of hard work on our end. We need to make sure that we're correctly structured, and perhaps it comes at the cost of our business. But I think what we see is that we can offer something which is compelling to the market and really enables us to be differentiated from our competitors in an environment when everybody else is more likely stepping down as the market steps down. We're moving the other way. It becomes compelling to investors. The key thing with Class A as well is that it offers investors liquidity. So maybe just to unpack the mortgage concept a bit more, private real estate credit has really grown over the past decade or so from being kind of a fringe part of the markets, in 2010, 11, 12, to now really being mainstream and invested in by the biggest institutions in the world. And people like it. Why do they like it? Because it's simple and intuitive. What I mean by that, instead of a super complex investment which no one understands, you don't need to be financial to know what you're investing in. You're investing in a deal which is backed by a property, and generally you know where the property is, what it is, you can drive past it, you can call your mate, the estate agent, who can explain it to you, you can read the valuation report. And the documents are pretty simple. You really are participating in a loan to someone secured against the property. So people really like that concept, that it's simple, it's clear, and it's intuitive. What people don't like is the fact that it's somewhat illiquid. Because you're really lending money to someone, you can't get your money back on a whim. You can't sort of, like if you own BHP, you call your broker or you go online and you press sell, and 2-3 days later the money's back in your account. You're kind of stuck in for a term. So what we've done with Class A is we've designed a product which both gives people that concept that they understand, the mortgage, the borrower, that they can trace through to what they're actually investing in, and the fact they can get liquidity. So the Class A of the credit fund actually gives investors the option for monthly liquidity. So on 30 days notice, you can actually get your money out every single month, and again, we don't compare directly to term deposits because it is a different risk, but a term deposit you might be locked in for 6 or 12 months, depending on the term that you've chosen. In the case of the credit fund, on 30 days notice, you can actually get your money back.
Mm-hmm. So you've got the confidence to increase the interest being paid on this Class A. What's the difference between Class A and B and C?
It's a very good question. We actually go Class A to F, and I won't step through every single one of them.
No.
I'll just give you the bookends and the concept, right? So as I mentioned, we run this business, which is an integrated manager, and we see a lot of deals across our desk. Some more risky, some less risky, bigger, smaller, backed by residential property, industrial property, land, first mortgage, second mortgage, the whole range. So we see so much traffic across our desk that we thought, let's put together a credit fund with 6 different options that gives investors a range. So if you kind of think about risk and return, at the lowest end, which is Class A, our 605%, that's paying 6.5% per annum interest paid monthly, is our most conservative. So that is the most liquid, lowest risk end of the spectrum. And at the other end of the spectrum, Class F pays north of 12%. And then, all the classes in between, they offer different options with different things. So it really gives investors the option, if they want to play private credits, they can play conservative, they can more cash-like, or they can play more equity-like, or anywhere in between that they choose to play.
So you're being quite transparent about that. I've had a lot of conversations with private credit managers lately, some of whom are concerned about the number of players in the space and their understanding of how to write these loans properly. So what you're doing with your investors is just being very transparent about the level of risk.
So I'm pleased that you raised that, because we've been going since 2012. We've got a team of 80 odd people. We've got offices all over the country, and we've written and funded closing on $6 billion worth of transactions. However, on the face of it, the barriers to compete with a business like AltX are theoretically quite low. I say somewhat in jest, if you've got a set of loan documents, if you've got a mate who'll give you some money, and a few brokers or borrowers, you're in the game. You can compete, which is quite rare to be able to kind of theoretically step up and compete with a business which has been going for a long time when the barriers are so low. However, there are many more factors that need to be considered when you're actually making a loan. Just for an example, right? You may appoint a valuer to value a property. You might think all valuers are created equal, but the quality of their work, the expertise in different markets is very, very varied. And you can get a legitimate valuation which marks a property at $1 million, and another valuer might mark the property at $700,000. It might sell for $750,000. So if you're going to lend security against that property, you want to know what the real number is, what it's going to sell against. So if you're lending against $1 million when it's only going to sell for $750,000, if the borrower starts to wobble, you're going to be in trouble. So what I'm really saying is, on the face of it, it might look like it's easy to come into the market, but there are a lot of nuances in being in the game that you need to understand, because if you get those wrong, you can find you trip up pretty quickly.